Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, April 30th, 2021. As we head in the final hours of the last trading day of the month, I'm going to do something a little bit different in this video, and that is focus on the very long-term charts, the long-term outlook for pretty much gold and the stock market. So we'll look at some market-leading stocks, we'll look at the indexes in the S&P 500, but I won't go through 1,000 charts here because, again, I've covered the short-term levels to watch ad nauseum lately, quite a bit. So you guys know what I'm looking for there to trigger the next sell signals or keep the trend intact if that's what happens. I think the next sell signals are coming soon. Let's start out here with gold. I'm going to just start here on this one on a daily time frame because I just want to kind of recap for those not familiar. This is a buy zone right here I've had for many months now, and we're back to the bottom of that buy zone. So we had two tags at the bottom of the buy zone here, which is solid support. Top of the zone I've had labeled for many months as moderate support with more solid support down at the bottom of the buy zone, which comes in around 158. We hit it twice, so two opportunities for long-term investor. There's a long-term downtrend line right here as well that came into play at the time, and we went on to recently break back above the top of the buy zone. So consider this also the top of the buy zone. Support once broken becomes resistance, and right now we're back testing on it. And there's also this trend line, not the best trend line because we had this little whipsaw here. I think you can see what I'm talking about. I'm going fast, but a little breakout and then failure. But there are enough reactions, so I'm leaving that trend line there, and we've been back testing that. So here's the thing. For long-term investors, I think this is still an objective area to continue scaling in. I'm longer-term bullish, but near-term, remember, don't ever confuse my near-term outlook for something with my long-term or intermediate. They quite often are completely different things. Near-term is what we're looking at days, hours sometimes, or maybe a couple weeks. So an update there. Remember that gold is dollar sensitive, and I've been highlighting this uptrend line in E7, which was broken today. So this was both a trade idea if you wanted to short the euro. We had a breakdown there, a little consolidation, and then one of the biggest drops we've had in a while, and that's because that support level broke. So it's probably going to take us down here to that my target zone, the buy zone there. And very near term, that may put some additional pressure on gold because of that. And remember, the dollar and the euro move are positively correlated. They move together. Here, I'll show you that. There's the gold chart. Gold broke down below that trend line. Down a little bit today, nothing big. In fact, it's pretty resilient considering the move. And there's a breakout in the dollar. I've been highlighting this. Downtrend line on the 60. Actually, it's a 2-hour chart. You can look up here, 2-hour candles. And again, this is how technical analysis works. We didn't just limp through there. We broke out, and that's a big ramp up today. One of the bigger moves in recent weeks or even recent months in the dollar, because it was a clear breakout of a well-watched technical level. Now we're coming up on the first resistance level, and there's your seconds. I think this will be fleeting, but near term, hard to say. I mean, there's probably a little more upside in the dollar, a little more downside in the euro based on those targets I have, which again may or may not put pressure on gold. It usually does, but if the stock market starts to go down, maybe you get a bid for safety. Here's the thing. I don't care to short gold. I'm longer term bullish, and I'm going to get to those charts and talk on it real quick. Before I do, well, let's roll into why we're still on the currencies, the euro. And this is a chart I've covered, and again, I haven't updated it in a while, but it's my long-term chart of EUR USD. Let me just park some of these indicators out of the way here. We have a little cleaner chart to work with. There it is. This is the primary downtrend line right there. Again, this is a weekly chart. The data started populating back in 2008 here, so that's what you're looking at. Well over a decade. And it's our bear market downtrend line. A downtrend or a primary bear market is defined as a security making lower highs, which each of these were. There's a high, reaction high, another one, another one, another one, another one, and another one. So you could still say by that metric we're in a bear market in the euro, meaning the dollar is in a bull market. However, we took out the downtrend line. We had a divergent low right here. First we had a divergent low here, and that was bullish, and we took out the downtrend line. There was your buy signal. We had a strong rip up, which took out these previous reaction highs. There was some consolidation, a basing pattern, We had a nice rally. We came back, put in another divergent low as highlighted at the time, took out the downtrend line right here, nice rip up. And what changed this time, at least for me, is we took out, as I expected we probably would, the primary downtrend line right there. There's a breakout. Here, we'll zoom in real close. There's the breakout and a back test, and that was highlighted here. And we'd probably get a rally in the euro, which we did, which would benefit gold, which it did. A little pullback today, but based on this chart, indicators are looking bullish. The PPO is turning back up here, starting to curl back up above the zero line. We had a divergent high there, so there was a correction to be had in the euro, and again, it laid out in the charts in advance when there was our breakdown. And so I view that. Here's my take on it. Bottom line is, I view this as a breakout back test. And what you want to watch for in the coming months would be a break above this previous reaction high, and then a big one here above that reaction high back from early 2018 or so right there. Why? Because that would have all the makings of a new bull market. Higher lows, and if we can take this one out, especially higher highs. So that's what we're looking at. I think we're headed there, and again, we'll let the charts dictate it. You can also look at USDL, DOLR on this platform, either TC2000 or freestockcharts.com, and you can see this was the divergent low in the dollar right here that gave us this near-term rally, moving up right there. But longer term, I think it's a bear market rally at most, probably take us up here, maybe not even that much, and again, that would be longer term bullish for gold. Now let's look at gold. That was the daily chart there. Let's jump all the way out, and this is what we're going to spend most of this video on, looking at monthly charts. Monthly charts, we can go back as long as the data populates, and usually decades or more, depending if we're looking at an ETF or a sector. Remember, ETFs, the modern ETFs really started to evolve back in the late 90s, early 2000s, and gold, for example, GLD came to market here in like 2004 right there. So that's the history we have on it. All right, so looking at this. All right, this was our last bull market, and we're going to talk about this when we get to some of these securities. You have two types of bull and bear markets. You have secular bull markets, which the stock market is in and has been in for decades. That's your larger trend, which is viewed usually over decades, many decades, and that's what I believe gold to be in. Then you have, so that's a secular or a larger bull market. Then you have cyclical bull and bear markets, and so looking here, this was gold from 05, shortly after the ETF came out. It was in a bull market. Corrections are normal, they're come along the way, and that was our bull market. It ended back in 2011, followed by a cyclical bear market, and that took the price of gold down from high to low, about 46%. So every bit of a bear market, and it also lasted for years. That's the other big thing. I'll try to talk on that in a little bit. So that's it. And then as highlighted back at the time, we set up with this downtrend line at support and broke out and consolidated for a while. We based for years here, and the big level to me at the time was 131 in gold, and that when that breakout happened, that's what I had been waiting for quite a while. Boom, that was it. Big green candle, and gold didn't look back. And then to kind of recap, right here, coming up to that level, that was our previous bull market high back in 2011, and I stated, that's where I personally took, profits on long-term positions, expecting a decent correction. Remember, no bull market goes straight up without corrections along the way, and the corrections can last for many months, and they often do, sometimes even years, and measure well into the double digits. And so that's what we had so far. So I'm going off the thesis now, right or wrong, only time will prove me right or wrong, that this was a correction in an ongoing bull market. And you know what? Gold could even come all the way back down here. And if it does, I'll be getting very bullish and buying back into or adding to positions at 131 on gold, silver, the mining stocks, and things like that. However, there's a potential uptrend line right here to watch. And again, I made the case on the daily chart to step in and buy it. And big level will be if and when we rally up here to that previous high around 186, 187. There's our we have a brief momentum fueled overshoot. You can see that candle. The skinny part means intra-month we rallied above there because the momentum carried us through resistance, only to close back down below it. And that's why I always say, anytime you're trading a security of stocks, you need to watch the candles on the time frame you're trading off of. See, this is not, I don't care what gold does today, tomorrow, next week. That's short-term stuff, and I trade it. That's active trading. But these are long-term positions, IRA accounts, 401 kids, college money, things like that. And this is what I like to watch, for the longer-term trend and help identify a trend or a potential trend change like we had down here. So there's gold, and that's what you want to watch for. Now let's talk about the stock market. Okay, we'll start out with SPY, the S&P 500 tracking ETF. Even though the S&P 500 index was around longer, there's no need to go back 50 years here. We'll go back to 1988 or so when this ETF came out. And what stands out are these divergent highs. And I'll say this, on the monthly chart, I've noticed on most stocks, most indexes, most securities, what you look for is if you get bullish divergences at a low, great. You want to look for those bullish divergences. We had one right there, and those often signal trend change. And they're usually pretty small, the lows, because the thing about trading stocks, I talk about this often, why I like shorting stocks as well as going long. Stocks tend to fall a lot faster than they rise. You guys remember that. You don't have to be around a long time. You don't have to you didn't have to trade through the last bear market in 07 to 09, nor the one in 2000 to 2003, but you know what happened during COVID, and that's a great example, and that's just how it works. And therefore, you don't get the big multi-month or multi-year divergences. And again, this is a monthly chart, monthly candles. That's why these divergences will last for years, usually build for years until they play out. And as I often say, not always, but much more often than not, they do play out for a trend reversal. So this one back in looks like in 90 played out for about a 20% drop or bear market, then 51%. That was the 2000 to 2003 bear market, or 02, I should say, bottom in 02. The Great Bear, or the Great Recession, they called it, 2007 to 2009, 57% drop, 15 right there, 20, and then 36 into the March lows last year when COVID hit. And each and every one of those, what they had in common, I should have moved that line there, even that COVID one had negative divergence on the RSI. And now normally, okay, you get a bear market and then it's over. And then the divergences are gone at that point, and then you start a new bull market. Remember, secular bull market right here that the S&P 500 is in, cyclical bear markets. One, well, you can count that if you want, 20%. 2, 3, that was right around 20. Let's just count the COVID one, 36%. So those were our cyclical bear markets. Now me, I might be different. I don't always just do what everyone else does. I don't consider that drop into the March lows. I've said this before, a bear market. It was a correction. Bear markets need to go down. The old definition is at least 20%, but they also need to last for at least a year. Most of them last 18 months, sometimes more, and that helps wash out dead weight. Companies that have been benefiting from a rising economy, strong, but there's too many excesses, too much competition. You need to wash out the dead wood, kind of like the way California and here in Florida, they do those prescribed burns, the forestry department. They come in and they burn down the undergrowth on purpose every few years, because if they don't, it grows, and that's more fuel for the fire that'll take down 100-year trees and all once it finally ignites. And that's why recessions are actually good for the economy in the long run. And the Fed, I call this Ursa interruptus is my term for what happened here. That's a bear market interrupted. We broke a primary trend line, and the old saying is everything has its price. That's if you call a collector, hey, I want to buy your Ferrari, not for sale. That's my baby. You write a big enough check, that guy's going to sell the car. And Fed wrote a big enough check here to avert what would have been a bear market. You got to give them credit. They gunned it. But where I differ now, I think they're keeping the pedal in the metal a little too hard here. Either way, there it is. Let's not talk much more about it. Sell signals come on trendline breaks. We have one here. We already had a trendline break on the S&P 500 daily, but there's some other levels I'm watching. So on the weekly, I'm gonna draw it like this right now. It's not the best to find. And remember, divergences, although they often play out, not always, they can get burned through. Right now we have where we had divergence there at the 20% drop. You notice a pattern. Then there was a bigger drop because it was a bigger divergence. And now it's even bigger. The same divergence has grown even larger. and it's still very much intact and will be anytime soon. When you look at the RSI, we can go up another 10, 15, 20% or more. You have to take out this previous reaction high from earlier, late 2017, early 2018, in order to take out or negate that divergence. So that's what the S&P 500 looks like. And if you're kind of getting whipped around when you follow my analysis, I'm always talking about short-term charts. There's never been, at least not in a long time. We had one here, we had a breakdown, but then we hit these long-term targets. It came real close on the S&P 500. I had bear market targets for the next bear market from back here down to the about the 212 level. I was always targeting these previous highs, and we hit it in the Dow, and a lot of other indexes hit that. I'm talking about that sideways market back in 2014 to 2016. So price-wise, the measured target was hit, the minimum target, but time, I don't think it did it. Now again, you short without a sell signal, or especially trend positioning, meaning when do you get out of most of your long positions? When do you put on some swing shorts, maybe index shorts that are leveraged short, or individual stocks? Well, you're going to need to get a sell signal, and right now there's nothing remotely close to a sell signal on this monthly chart. You can look for bearish, candlestick reversal patterns. Trend line breaks are usually the best one. Right here, for example, there was our COVID drop right there. That was early February. We broke it. Solid monthly close below this uptrend line right there, and the rest is history. So that is bigger picture right there. Now, stay with me. We're going to cover a few more, and then I'm going to cover just a few of the market-leading stocks, the biggest stocks in the NASDAQ 100, many of which are in the S&P 500. And time permitting, I'll watch the clock. I'll just run through the sectors of the S&P 500. And again, this helps paint the bigger picture. For those of you wondering, hey, what's my 401k going to look like in 5 years, 10 years? What is the outlook for the markets? Right now, the trend is bullish, and it's hard to say because what the Fed did back here was unprecedented. And what they're doing now, keeping the pedal to the metal, is unprecedented. I think there's going to be grave repercussions for staying too easy, too long. But we'll see. All right. So what we do know is on the NASDAQ 100, here was again a cyclical bull market within this larger secular bull market we're still in, and there was a cyclical bear market. And the NASDAQ 100 has more juice and usually falls more than the S&P 500. That was an 83 or 84% drop back from the peak in early 2000 down to the lows in 02. Then you had a bull market. That bull market ran for about 5 years, and the gains were, just to measure from low to high, about 170%. And then here is where the Fed started supersizing things. After the financial crisis, coming in with the zero interest rate policy, quantitative easing, and all that good stuff. They've triggered this. This is the we'll go down in history probably as one of, if not the greatest bull market. And then sooner or later it's going to end. When's it going to end? Well, there's one clue right there. There's a nice trend line with plenty of reactions since the 2008 and 2009 lows. I'll pull back there, and all these trend lines eventually get visited. So at the very least, even if you have a correction or another cyclical bear market within this larger secular bull market, maybe it has many, many years left in it. That would be a minimum pullback target right there. Oh, sorry for the pause, guys. I was trying to figure out what to queue up next, and I think I'm going to do the individual stocks, and the time permitting, we'll run through the sectors of the S&P 500, at least the top sectors. All right, here's crowd favorite. This is Apple. This is the world's most profitable, or at least most beloved company. I don't know, Saudi Aramco might have higher profits, but again, that's, this is a U.S. company. As it says here, this 30-year chart highlights the cyclical bull market tops and bottoms, as well as the primary uptrend lines which defined each bull market. The percentage drop was calculated from the previous bull market peak, where the arrows are, down to the trough. And so you can see here, and you know what, I don't have all the different, a couple things to note. Every chart's different. This one I have, oversold on a security is typically, and most charting programs are going to give you a line at 70. which means the security is overbought, and they're going to give you a line at 30, which isn't showing on here because I guess we never even got down there, but 30 is oversold. That'd be down here somewhere. And typically you want to be going long or covering shorts when you're oversold, especially in a bull market. It's rare to even see it. You can see Apple hasn't even gotten near the 30 level in decades now. But I don't go off just the defaults. I look at every security different. Why? Because if you short Apple, when it's overbought, with RSI at 70 on the monthly, you're going to get clobbered, because from there it usually had a little initial correction, but it kept getting much more overbought. So the number on my chart is right around 88. That says 87.91. We'll call it 88, and you can see what happened there. So overbought at that level. Better take profits on your Apple, or at least quit buying into it at that point if you have it. Again, this one wasn't a big correction, but I guarantee you that was double digit. You're looking at log scaling. This is 5 cents right here, and there's 300 on the scaling of this chart. With Apple 133 now, you turn off log scaling, you can't even chart a stock. Don't ever try to look at a 40-year plus chart, 30-year plus chart on Apple, because that's what it looks like if you turn off log scaling. It just looks like the stock's gone parabolic, because log scaling will put every candlestick in percentage change, not dollar changes. When a stock goes from 25 cents to 50, it doubled. But when it goes from, up here, it's got to go from 50 to 100 at double. So that's what puts everything relative and equals it out. So, all right, that's that. All right, back to the numbers. So there it is, 59% drop. And I do this because, a lot of people think, oh my God, Apple's quarter. I mean, if you read the profits they just reported, and the company is a juggernaut. Every quarter is better than the previous. The amount of money this company makes is insane. What happens, it just sometimes that's priced into it, just gets too heavy. Everybody that's bullish on Apple has bought his or her last share, and it corrects. And the drops are big, 59%, 70, 74, 83, 62, 45. Back here, and again, it was called down here. At the time on this chart, I said, look, we're only at a 32% drop, but I had a target lower, so I said, was that it? And no, there was more downside. So all said and done, it was 34%. Right here, after that peak, 39% drop. So you have to, if you're a long-term bull on Apple and you have shares, and you say, well, you know what, I'm going to tuck it away forever. If you're young, if you're 20, 30 years old, you can do it. You can ride out these 40, 50% drops. But if you're getting up there close to retirement, you might want to heed the warnings next time we have a sell signal here on Apple. And what might, what gives us a kind of heads up, it's getting a little frothy, this RSI divergence. We didn't quite hit that 87 level on the RSI. Again, not that that's where it gets to every time. There's been plenty of tops where you were between the 70 level overbought and that 90-ish level. But what I look for as well, as I told you in the beginning of the video, is RSI divergence, more so than the PPO. We had RSI divergence here at this top. We had RSI divergence here at that top, which, that was over a year-long correction before the stock lost 34%. We had negative divergence there on the RSI, 62% drop. None there, still 40% drop, but we do have it now, so that's something to be aware of. And if Apple continues up and puts in a marginal new high anytime soon, I just move these lines, and it would take a hell of a run on Apple from here to burn through these divergences. Meaning, how do you burn through them? You have to take out this previous high right here in the RSI, and we're not even close. So we'll watch the levels on the daily chart to give us a heads up when it might be time to pull, the plug or tighten stops up on a long-term position in a stock like Apple. And keep in mind, if Apple has another, double-digit drop like this, it is possible, but very unlikely, the stock market is going to continue higher because of the weighting that Apple has and the psychological importance to the market, and the fact they're tied into the business cycle like everybody else. What's going to cause a 30, 40, 50% drop in Apple? Well, it's going to be a a recession, or at least drop in profits. And here's Microsoft, Mr. Softy, big tech name, one of the largest companies in the world, been around a long time. What happens when a bull market finally ends? Again, Microsoft, by this chart, hasn't even had anything remotely resembling a bear market. The bull market in Microsoft started right here. Like many tech companies, like the stock market as a whole, which bottomed in March of '09, a lot of big tech bottomed in October of 2008. Now, so here was our last bull market, or previous bull market, the great one up from the 90s to the 2000 high. That's when the dot-com bubble popped, tech broke. And so if you said, oh, I'm going to hold on to Microsoft, ride it out. Well, that was about a 70, I measured it before, about I think over a 72% drop. Remember, log scaling, doesn't look like it. And it lasted, before all said and done, you watched your account go down and down and down for 9.3 years. That is where it peaked, bottomed right there after the peak in early 99. So these, again, all I'm trying to paint here is the cyclical bull and bear markets within a larger secular bull. There's no mistaking about it. We're in a secular bull market, and that even won't last forever. I hate to do these little tangents. What would end that? Well, it's no coincidence. I've covered this many times. Interest rates peaked back here. Think, Carter leaving office, Ronald Reagan back here in the early 80s, right there. This is the 30-year Treasury bond yield. We've had falling rates due to easier and easier Feds and market forces for decades now. Again, going back to the 80s. Is it any coincidence, and you overlay this chart, that the S&P 500 goes like this? No. If you study the financial markets, you know this, and if you don't, you can look it up. Falling rates are bullish for stocks, rising rates are bearish. So the million-dollar question is, we know we can't go any lower. Fed took it down to the floor, and again, this is the 30-year. That's why why aren't we at zero? The Fed only controls the discount rate, the overnight rate. Banks borrow and lend to each other, or directly from the Fed. They don't control this long-term rates. The Fed has had rates at zero now for a while, and the long bond is starting to move up. Inflationary forces, everything I've talked about before. So you want to know when it's time to get out of Dodge, and you want to consider the outlook for the next 20, 30 years if you're investing. It's just not good because there's no more downside in rates. The best we can do is stay at a very low rate environment for many years, which eventually the economy is going to get used to rates being this low, and it's not going to have that stimulative effect anymore. But sooner or later, this all trends end. That was a secular, again, multi-decade bear market in interest rates. And my biggest fear is that if the Fed is wrong, if Powell's wrong and I'm right, and he's calling these inflationary forces as transitory right now. He thinks they're just transitory because commodities been in a bear market for a while. If they're not, and inflation and interest rates get out of control, then that's not going to be a good sign for equities. So just keep that in mind. We got a long way to go. I always do updates on bonds, so let's get back to the stocks and we'll wrap it up. Okay, Amazon, one of the better, like I said recently, at least on the daily chart, best in class or best in show, talking about the fangs, but big divergence building right there. I haven't marked up all this chart. There was a divergent higher there. There was one right there. You can put, these are your divergent highs right there leading up to these drops, and then your sell signals with the trend line breaks. These lines didn't populate, but I imagine we had divergence there. So in these drops, again, measure well into the double digits. That one was almost, the stock almost got wiped out. I mean, it was nearly a 90% drop. I didn't grab the exact high. Even this one right here, let me just measure that out. This was a 67% drop. So again, when log scaling doesn't look like much, but here's your big secular bull market uptrend line. And what never fails to amaze me is how clean these lines are. So, this isn't going to be today, tomorrow, or next week where I'm talking about these trend lines getting broken. But you keep these in mind, replicate these on your charts. And also note that these divergences are building. So at the very least, these stocks probably sooner than later, sometime in the coming months, will come back and revisit this bull market uptrend line. And just to have Amazon come back and check that trend line, depending on how or when it gets there and when it peaks. Right now, the way I'm holding this, let's just say that's about a 43% drop. Just to come back in a little, relatively, it looks small, correction, would be about a 40+% drop. And again, came back in here, and that's when you want to buy. But you have to be careful when you have big divergence like this. These were smaller divergences, and they just caused relatively minor corrections. All right, let's move along a little faster. Facebook hasn't been around as long as most of them because IPO was in 2012, but there's still a pretty clean uptrend line. And again, Ursa interruptus. That means interrupted bear market in Latin, if my Latin's any good. So there it is, but went down intramonth, but then closed right back on the trend line. And then this green candle means we closed above it. So that's the trend line to watch. And there's that 40-week moving average as well. We were below it there, and that was, it told you to get out. If you waited till that 40-week went, it was about another 25% drop there. So those are levels. And I like the fact a lot of these primary bull market trend lines come in together with that key, I called it 40-week. It's 20-month exponential moving average. I like the fact they come in together. So that would be no bueno for Facebook to see both those levels taken out on a solid monthly candlestick close down below it. And again, even if we plunge today for some crazy news event, it wouldn't mean anything until, well, today's the last day of the month, so we'd be, be May. We'd have to wait for the May candlestick to close. All right, so that's you get the point. Google, and again, the takeaway here is a lot of these are their bull market trend lines off 2008, right there, 2008 or 2009, and they're diverging. And there's Tesla right there, big divergence on Tesla, and there's uptrend line. It looks like a big rising wedge on this monthly chart. We're already below it. There's a sell signal right there on Tesla. Solid monthly close below. Why isn't Tesla falling? Well, it's a top component of the S&P and the broad market, and sentiment's very high. People want to buy Tesla and get on board, but this one, if you want to tuck it away as a short and put a stop above the recent highs, I think it'll pan out. There's no guarantees. Maybe it comes in and back test. You wouldn't want to be on a back test on a steep uptrend line like this because it's too steep. It'd be too much of a move. If it was a more gradual slope, and you broke down here, you could hold off and put a stop a little bit above where you entered. But either way, that's where I suspect. And I think before all said and done, I've given you targets on the daily and weekly charts. Let's just say right now, minimum target there, 2 targets minimum. Right there and there, about 522 and 390. All right, I'm not going to do each and every one. I could go down the line and do this all day long, and the thing is, all these charts are so similar. Bull and bear trends, cyclical bull markets like this one in NVIDIA, one of the biggest chip semiconductor makers. Clean bearish rising wedge on this monthly time frame spanning from 1999 up to 2002. There was your breakdown, also had negative divergence confirming the bearish nature of that pattern and the likely trend reversal. Then, cyclical bull market right here, and that bull market ended when we broke this nice clean uptrend line with that wedge, the negative divergence on the RSI. And again, the stocks like this, these semis move. That was an 82% drop, 82, 83. This first one was about a 90% drop. So there's a lot of meat on the bone when if you get one of these trends, 57%, and you don't want to ride them out long. If you're a pray and hope investor, instead of buy and hold, they call it pray and hope. You don't want to ride out the next bear market, especially because the indicators, these divergences are so much bigger. What the Fed has done is just inflated this ginormous bubble, and right now the momentum is strong, the economy is strong and moving in the right direction. How much of that's priced in? Again, the charts are going to tell you long before the government's going to tell you that we're in a recession or it's time to get out of the market. Targets there, 296. And what I'm circling is that we had divergence at that last high right here. There was your divergence. There was your trend line break and back test, and NVIDIA fell 59%. And now, after that divergent high, we didn't negate the divergence, it just got much bigger. We have multi-year divergence now building here on the RSI. There's our primary uptrend line right there to watch. There's big support and also potential price target at about 296. We'll call that 300. And then if and when that goes, we come all the way back down to 129. That would be about a 78% drop, in line with a lot of the other bear markets in NVIDIA, because the chip sector is just so cyclical. Gets ahead of itself, a lot of demand, and then there's a flood of chips on the market. All of a sudden, the brakes come on the economy, demand slides. There's a surplus of chips, and it takes a while for these guys to move around. And of course, momentum traders jump out of these stocks when the trend finally breaks. And just a few sectors, no need to do them all. XLK, there's our bull market uptrend line right there. We had divergence there at that first big drop that was well into double digits. There's a next one that was a COVID drop into last March. Divergence there, and just bigger divergence on the tech sector. And where will the next correction take us? Probably back down to this trend line here, revisit that trend line. But right now the momentum's strong. You short now, it could be here, here, here. Or if you're really unlucky and you short, we take out this divergence and it's no longer in place. So keep that in mind. That's why you wait for the sell signals, and that's why you watch the the 60-minute and daily charts to kind of hone in on your entries and exits. And then for trend or long-term positions, you confirm it with the monthly charts here. XLV, this is healthcare, big sector in the S&P 500. That was our primary trend line, which was broken here and it's been being back tested this whole time, but I added this BOD, benefit of the doubt trend line, and you can see last bear market, there was our breakdown. We had a close below the primary trend line and that awesome 20-month exponential moving average. If you didn't get out, you were given a gift on the back test of the 20-month to get out of your long positions. And if you didn't heed that, take advantage of that opportunity, you then rode out a 38% drop. And it was pretty ugly. These are monthly candles, so that was just 1, 2, 3 months later, you were down 38%. That's why you can't stay late to the party during these trends. But as long as the music's playing, a lot of money to be made. All right, that's XLY, and I'm going through the order of market cap in the weighting, I should say, in the S&P 500. Tech was number 1, healthcare was number 2. This is number 3, financials. Fed is certainly get the back of the banks right now with these uber low rates, especially with spreads widening. With the inflation trade, or call it what you want, long-term rates, you can't argue, have been moving up, while Fed is keeping short-term rates at near zero. I used to work, I was a stockbroker, financial advisor, but I worked for several banks, brokerage programs. I know how the banks work very well. One of the main ways they make money is a spread. They take your money in, and you put it in a checking account or a money market at zero or near zero now, and they turn it around and lend it out in car and boat loans and mortgages. So when long-term rates go up and short-term rates are low, they're just making money hand over fist because the spread is very wide. What they don't like are inverted yield curves, and they got to pay you higher interest, and they're turning around and lending the money out. So as long as the music's playing, that's good for the banks. But there's other things that can take them down. So just watch right now. That would be my uptrend line to watch. And again, there was our first divergent high, and when COVID hit, they dropped 43%, and now we have an even larger divergent high. So something to note. XLC hasn't been around long enough. All you have to do to chart XLC is just follow Alphabet and Facebook, because they make up almost that entire, over half of that, the ETF, that sector. So there's no point. And it's a new sector. It replaced the old telecom sector, so I don't have a long-term charting history, especially on the monthly chart. A few more, and we'll wrap it up here. XLY, consumer discretionary. There was a primary trend line break again. Right there, it was a beautiful trend line. It was taken out, and the Fed came in, and we actually hit support again. These were when we were still in a bull market, my next bear market targets on this one, 96.41 and 81.82. That was that trading range in 2014 to 2015. It was big support, and a lot of sectors and the indexes like the Dow and the S&P, almost Dow hit it right to the button, and that's where the again, called a bear market or a quick correction, that's where it ended. And strong sector, but divergence is building. XLI, these are the industrials. Again, pretty big component of the S&P 500. There's a bull market trend line, bull market, divergent high. Nope, not divergent high here on this one, and just big divergence has been building there. So let's stop here. I do this all day long, and you'll see divergence, and that's it. So it's not a sell signal, but it's an indication, hey, the trend is waning, because that's what divergences talk about. These are momentum indicators, the PPO, the RSI, and it's showing you as strong as this rally is, and when you step out, now I'm not talking since last March, that's the momentum's very strong, but in the bigger picture, going back years and even decades, the momentum is waning, and that's what the whole nature, the whole point of divergences is to sniff out when momentum is waning, as well as when things get overbought. And then you just sit back and wait for your sell signals to either short or get out of your longs. All right, we're going to end it here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.